This is a segment that I call off the chart because off the chart is how I trade. I take a look at price action, I make a determination as to what I think the psychology is telling me I should do, and then I make a decision to trade off the chart. So the setup that I'm going to be talking about here today, this is more of an educational segment. I'll try to do more of these. Again, the off the charts will be a little bit more explanation of my trade entries. If you want to see more of my proactive trade entries or management, check out my Forex 2-minute drill. That'll hone you in on setups and ideas that I'm focusing in on now. So taking a look at the 15-minute cable, this was an update that I had written about over at the Daily Forex Trading Edge, which is a blog that I write for Interbank FX. And the update that I had written about, first of all, focused around the directional bias, which I think is firmly shifting to the bearish side on the daily chart, which gives me what I call a bearish directional bias. The reason this is so important, this daily chart interpretation, is because once I've got a daily directional bias that's either bullish or bearish, as in the case here, I can then start to look at the individual time frames, intraday time frames, and get a better idea of whether or not I'm trading with the trend or counter trend. This is important because I will only trade counter trend on short-term time frames like the 5, the 15, and the 30. The 60 I sometimes will trade counter trend, but for the most part the guideline is not to trade counter trend on the 60, and the 240 is a definite negative on trading counter trend. So if the daily time frame is now showing me a bearish directional bias, then I've got to understand that any long position, any buying entry, really now has to be limited to the 5, 15, or 30-minute time frame. The 15-minute time frame, again, was the subject of my Daily Forex Trading Edge update, because as the directional bias was shifting to the downside, as we were testing the big 6,000 level on this chart, what was happening is we were actually trading down lower through the 34 period EMA low as well as 6,000, all in this same area. The way I confirm this entry, which I call a wave reversal, is that I utilize a commodity channel index. There we go. Not to be confused with the continuous commodity index, which is a futures contract. So I utilize this on a 20-period setting, which is based upon the lunar cycle. That's how I learned it 2 decades ago. I still use this very slow setting. That's the way I like to trade, using most of my indicators, slow settings. So here's the setup. I wait for the 34-period EMA low, in this case, to be broken, and accompanying that break, which again was at 6,000, near that 6,000 level, must be a negative 100 or greater. In other words, negative 100, negative 101, negative 102 reading of the CCI to confirm that the shift is now giving me more bearishness. Before I can take this wave reversal setup, I just won't take any old breakdown through the 34 period EMA low. What has to precede the trigger is a trend. So this really is a trend reversal in what I call a short cycle or a quick transition. So in other words, instead of the market going from an uptrend to a little bit of congestion or consolidation, then to a downtrend or even a continuation of the uptrend, what happens is the market goes straight from trend to trend. We've seen those in the form of U or V bottoms, U or V tops. But how do you take advantage of that sharp transition from bearishness to bullishness, or from bullishness to bearishness, as in this case? So I want to make sure that I've got at least somewhat of an established 12 to 2 o'clock trend, because I've got to have a trend to reverse before I actually consider playing a reversal. This chop here, you notice I never really got a great 12 to 2 nor a 4 to 6 in this area. Okay? So that's what I want to keep in mind. It's got to be preceded by a trend, preferably one that's on par with the previous up and down trends. So That's the first filter, if you will. The second is making sure that price action was respecting the support of the 34 EMA wave, because it's that support break in this case that we're hoping will generate momentum, in this case to the downside, that we can short into. So there's got to be respect for the wave if there was a test, which we really didn't have one here. Okay, so the entry again is prices break down through the 34 period EMA low, accompanied by at least a negative 100 CCI, and that triggers your short entry, and that is a wave reversal or a wave CCI entry.